Hey guys, this is Randy Finney with Right Side of the Chart. Today is Wednesday, March 23rd, 2016. This video will be very quick. I'll just post this in the trading room. I wanted to harp on or focus on the decay issue that I'm always harping on the site. Why my preference is often to short a leveraged ETF instead of buy one long. In other words, I haven't had any official trade ideas on GDX for a while. Did make the mistake of trying to catch a few pullbacks using dust that got caught in. Those were ended up being losing trades. But the last one that I posted, unofficial, was a nugget short. And I just want to really highlight the example of how these things work. This I've mentioned before, you can actually do better than three times in this instance when you have a nearly vertical rip with no givebacks. That's what I often talk about. That's also in the FAQ page under the ETF section or on the ETF page. I talk about the decay on these things and how in some cases you can actually get better than three times if you're in a straight up trend like this. Let's say a nugget, for example, from here to here. But what happened with GDX, the miners have topped out, and although it was a slightly upward bias in the last few weeks, it was a trading range nonetheless. This was, has been sort of it's a megaphone pattern drawn here, and but for the most part, you can see the momentum stalled out, and so really today, this is what I'm focusing on, and I'll just show you real quick the numbers and make the point of how this decay works. So really today, if you look at the line draw back, we're GDX has gone nowhere all the way since the 23rd of this month. I'm sorry, 23rd of February, and today is the 23rd of March. So 1 month. There's a candlestick. We've gone exactly nowhere in the miners, and that just has to do with one day. And that's the nature of this beast. The mining stocks. One day can wipe out gains made over months or longer in some cases, at least weeks of gains. All right, let's just look at the decay issue. All right, so I'm going to pick a point. What I did is I picked a point here going back 20 days. Let's zoom in a little bit more because GDX is down from that point. What did I use? Let's see. I already calculated the numbers just to make sure they lined up here. Yeah, the third. Nice feature about this TC2000 charting program, if you put the crosshairs and capture anywhere, like here's a candlestick and you have this shadow up top, also known as a wick, I can capture the wick, which is the highs, and measure to any point. If you look at the box in the upper left-hand corner that pops up, look down towards the very bottom in red, you'll see the total dollar gain or loss in 99 cents in that case, which is 4.5% or 4.95%. Now let's go back. Let's just focus on this day here, the 23rd. I'm sorry, the 3rd, 20 days ago. Gosh, getting all confused. All right, now the wick just represents the high for the day. So if I put my cursor closer to the top of the body, it will automatically catch it, so I don't have to do it perfect. So I'm right there at the top of the body, and all I'm going to do is drag over here, and I drag down to the bottom where we closed today. And if you look on the left, bottom left of the box, we're down 3.99%. Oops, there we go. And see how I don't have to be perfect. It auto snaps it to there. If I looked at where we were at today's highs, you can see it snaps up there. So we, at some point today, we were only down a quarter percent for the last 20 days, and we closed the day, as I just said, 3.99. I verified that math, by the way. I looked at the closing values on that day and the closing values today, and that matched up perfectly. So there it is. So 3.99. Now, what would you expect in Nugget? Normally, one might think, well, if GDX has dropped in 20 days 4%, then we're going to be down 12% in Nugget. Well, that's not the case because this is the perfect scenario, what I talk about, and this is why I love shorting those things. You don't have to have the timing so nice because you're getting paid to sit here. This is when you see all these up and down candlesticks, day up, big day down, day up, day down. This is the ideal recipe for decay on ETFs. This isn't. These up days can actually, as I said, benefit it, but when it's these choppy sideways trading ranges. And, I've held on to a nugget short for a while and let it get underwater. It's beta adjusted. My position size is nothing huge, so I didn't have to, worry at night. And like I said, the RR to shorting up there was very good. It's taken a while for these to roll over, and there's still some work to be done. But all right, let's just take a look and do the comparison here, and I'll wrap this up showing you one more thing. Where was I? Right here. Okay, there's the third. I'm going to capture where we closed. As you can see, Nugget closed that day at 61.62, and as of today's close, we're down. Let's see if I did this right. I have to capture the very low here. It's not working according to the math. If I got that there, February 3rd. Yep, there it is, 16.9. Again, I calculated the numbers manually as well, and I'm just making sure I capture the closing values. So there it is, 17% versus 12%. And again, if you take the 12% is what one would expect. In other words, GDX was down 4% over that time period. 4 times 3 is 12. Yet Nugget has dropped over 16%, call it 17%, and that's just over 20 days. And for those of you new to the site, I've put this chart up many times, and if that doesn't convince you, there is a possibility. I didn't check for dividends, guys. You got to realize sometimes ETFs, even if they're tracking the same index, they pay out different distributions, dividends, and that can adjust the share price as well. I didn't check for that. There is possibility that GDX and or Nugget made a distribution, affected the share price. But if that doesn't convince you, and again, you can check that. This will. I've posted this chart in the past. This is Nugget since the inception back in 2010. It came out late 2010. So there was no history to the left of this chart. And this is a long-term chart. And what it shows you here, I've zoomed in, and this is the percentage gain. You can see the price action. This is split adjusted. The stock has to have reverse splits all the time because that decay is constantly taking away or whittling down the share price. So they continue to reverse split this thing, and will, as long as this thing trades over time. Last time I put this up, it was 98%. You can see here it's 99.73%. So what this is the measurement from the inception that Nugget, had you put all your money, whatever you had or anything, you put $1 into Nugget back then, you would have less than 1 penny. You would have 1/4 of 1 cent. That is the percent decline, 99.73. Again, it was 99.8. I did that right before the big run up. So that big run up we had in the last couple months, took that down. But this thing will never, ever get back to where it was. It's virtually impossible due to the decay over time. So keep that in mind. And my point being that there are 2 times that you want to short. I know a lot of you can't short. You do have IRA accounts. You might not have a margin account. In that case, if dust is your only option, use it very judiciously, and quickly. Those things are really intended for day trades only. Once in a while, if I suspect a move will be fairly unidirectional, meaning either straight up or straight down, I have no problem, especially in IRA accounts or whatever, using that leverage and taking advantage of dust. But like I said, some like back here trying to catch a few tops that just didn't come, or they came but they weren't deep enough. Dust didn't work, but Nugget, it's paid to sit on it for this point in time. It's the inverse of that. The miners look good long term. You could, on the next pullback, and I talked about this before the miners bottomed. I talked about it all throughout here. My plan was, and I was long off the bottom. I took profits too soon, but my plan was to take a dust short and tuck that thing away and lock up the key. Didn't have that. Got too cute trying to game some pullbacks here along the way, and right now I still think the risk to reward favors the short side in the miners. I just think there's still a little more unwinding of this recent run up that needs to be done, but hopefully that illustrates, and you guys can use that tool as well on other ETFs. But I wanted to just illustrate the point that these trading ranges as well, obviously if you catch the right direction, that's when you want to be short, whether you're going short the long or the bearish or the bullish ETF. Okay guys, hope you enjoyed.